Thank you, Michelle, Yenny, Wendy, and Connie for having me as today's moderator. I am Winona Zhao, tax partner of EY. EY also formerly known as Ernst & Young. I have been with EY for more than 15 years, serving a wide range of clients. They can be as big as a Fortune 100 or as small as a startup. Recently, I published my first book, A Tax Guide for Investment in the USA. This book was written in Chinese, both in simplified Chinese and traditional Chinese. It is to assist Chinese readers to learn US taxation with comfort and efficiency. So if you are interested, you can find this book on Amazon or with many other book retailers. You can also go to my website, www.winonazhao.com, for more information about the book and to read the chapter excerpts. I guess I skipped today's agenda, but let's just get started. Today, we're going to focus on the corporate tax session. And in the video you've seen, there will be another session for individual taxes coming up next month. We will have more information for you later, okay? I haven't seen how many participants in here already. Michelle, do you know how many do we have for now?
Yes, we do.
Shall we just start it, or shall we give them one more minute?
Good.
We have a good audience right now already.
Yes.
Okay, I will just get started. So today's session is organized by two organizations. Thank you for organizing such a great event. As we all know, with the global pandemic holding a firm grip on the US economy, President Biden is moving ahead to address the pandemic and advance his broader policy agenda. The final results of the 2020 election cycle allow Democrats to use the budget reconciliation process in order to enact some of the Biden's business and individual tax proposals in 2021. The Biden administration's business tax proposal includes several sector-specific proposals and the president's Made in America tax measures that seeks to end outsourcing and promote U.S. domestic manufacturing and job creation. The potential effects of changing policies in the US and around the world, for example, corporate and individual tax rate increases, potential increased taxation of foreign operations, and a host of other proposed changes to US state and foreign tax laws may have a significant effect on your business. So today, we will have two outstanding speakers who will provide updates on the corporate tax and its potential changes. The first speaker we have today is Connie Lee. Connie Lee will talk about corporate tax provisions for outbound business activities. Connie is a managing director for the international tax practice for Deloitte Tax LLP. She has 24 years of experience and serves multinational corporate clients. Connie advises clients on all sorts of cross-border tax matters. She has also spent 2 years with Deloitte's Washington National Tax Office and consulted on complex tax issues. Connie was in charge of one of the Deloitte's publications, Global Tax Development Quarterly, from 2013 to 2015. Let's welcome Connie. I'll hand it over to Connie.
Thank you, Winona. Hello, everyone. Good afternoon, good evening. As Winona mentioned, I'm Connie Lee from Deloitte Tax, and I will spend the next 15 minutes to discuss high-level general rules related to corporate income tax on outbound investments And I will also provide a couple examples to compare the U.S. tax under current tax law versus under the Biden administration tax reform. When we talk about outbound, we generally mean U.S. persons investing and doing business outside the U.S. They can do business in a foreign country through a branch, a corporation, or a partnership. For my today's discussion, I'm going to focus on U.S. corporations doing business in a foreign country through a corporation. So as you can see from the slide, I actually have a picture there, and I'm going to use this structure to explain a couple of changes throughout the U.S. international tax history. So in this picture, I have a U.S. corporation that owns 100% of a foreign subsidiary 1, and also 100% of a foreign subsidiary 2. They can be formed in any countries outside of U.S. So as you probably can see from the slide, on the left side, you have 1962 Revenue Act, Tax Reform Act of 1986, and 2017 Tax Cuts and Jobs Act. Of course, U.S. has many tax reforms throughout the years. I have only listed the major ones here. So before 1962, before the Revenue Act, in the picture, let's say if a U.S. corporation sells its inventory to a wholly owned foreign subsidiary, for example, if it's formed in Bermuda, it's a Bermuda corporation, which then resells the inventory for a huge markup around the world. The profits earned by the Bermuda company is not taxed in the U.S., is not taxed in Bermuda, is not taxed anywhere. So this is how it works prior to 1962. Now, the 1962 Revenue Act introduced control foreign corporation and subpart F rules. So in my picture again here, because U.S. corporation owns more than 50% of foreign sub 1 and foreign sub 2, foreign sub 1 and foreign sub 2 are both considered control foreign corporations and therefore subject to the subpart F rules. So what this subpart F rules does is it painted the forms of income earned by a controlled foreign corporation on a current basis. So in my example, prior to 1962, foreign sub 1, which is a Bermuda company, when U.S. sells products to it and it has a huge markup by reselling the product to the world, nothing was taxed, right? The foreign subs earnings not taxed anywhere. 1962 Revenue Act changed it, and it says the income earned by foreign sub 1 is subpart F income, and therefore should be taxed in the U.S. currently. So that's the big change from 1962 Revenue Act. Now let's jump to the next tax reform, which is a huge one. It's called Tax Reform Act of 1986. So under this Tax Reform Act of 1986, the subpart F rule actually got extended, to expand it to cover more areas. So in the same picture again, U.S. would tax on the net income earned by U.S. corporations. The local country would tax the earnings earned by foreign sub 1 and foreign sub 2. But remember, we have subpart F rules. So subpart F rules makes U.S. can tax the income earned by foreign sub 1. Now, let's assume foreign sub 2 doesn't generate any subpart F income. It only generates non-subpart F income. So under this 1986 Tax Reform Act, U.S. does not have the right to tax the earnings by foreign sub 2 unless there's an actual repatriation from foreign sub 2 back to U.S. So that's the 1986 Act. So again, under this 1986 Act, earnings from foreign sub 1 is taxed in U.S. currently, while earnings from foreign sub 2 is deferred and not taxed in U.S. until there's an actual cash repatriation. Now, the next major tax reform is called 2017 Tax Cuts and Jobs Act, TCJA. So this TCJA brought in a lot of international key provisions. The first one I would like to introduce is, the one-time transition tax. So that's the second bullet point on this one. Remember in my prior example where under 86 Act, earnings by foreign sub-2 is not currently taxed in the US until there's an actual repatriation. So this 2017 TCJA Act changed this. So under 2017 TCJA Act, all of the untaxed earnings earned by foreign sub-2 from 1986 to 2017 would be taxed by the US as a one-time tax. Now, after that, if you want to actually repatriate tax back to the US, it would be mostly tax-free because US allows for a dividend receipt deduction of 100%, right? So, and also because all of the earnings were already taxed under this one-time transition tax, so repatriation should be tax-free other than some FX gains and losses. The TCJA also introduced another key provision for international tax area is called GILTI, or Global Intangible Low Tax Income. So basically, back to my example again, where I said foreign sub-1 generates subpart F income, foreign sub-2 generates non-subpart F income. So it started after the one-time transition tax, starting from calendar year and 2018, earnings earned by foreign sub-2 would be taxed currently in the US under this key provision called GILTI. And then another key provision that would impact quite a bit of clients, US multinationals, is this foreign derived intangible income. And I will give an example when we talk about FDIC in the next couple of pages. So next, let's talk about, we all heard about Biden administration tax reform. So that's another big one that we are expecting. So in the next few slides, I'm going to show you the comparison between the current law and also the Biden Green Belt. So I am going to talk about the three major ones that impact a lot of my clients, but other provisions are also listed here that may impact you or your company. So in the interest of time, I'm only going to focus on three. So the first one is the US corporate tax law. You probably already heard about this. Under current tax law, US corporations are taxed at 21%, but under the proposed change for next year, US would be taxed at 28%. So that's a 7% increase. The next change is called GILTI tax rate. Remember, GILTI is regarding the earnings by foreign sub-2 in the prior picture. So under current tax law, GILTI tax rate is 10.5%, while under the proposed law is 21%. Now, there are also two key changes impacting the GILTI calculation. So the first one is called per country calculation. So under current law, let's say in my foreign sub-1 where I generated loss and foreign sub-2 generated income, I can aggregate the two and only report the net tested income as GILTI in my GILTI calculation. Under the proposal, the Biden Green Belt proposal, GILTI would have to be calculated on a per country basis. So if foreign sub-1 and foreign sub-2 are formed in two different countries, you cannot net loss from one sub to income from another sub. So that would substantially increase some of the company's GILTI calculation. The second impact would be in the current law, it allows a 10% return of tangible assets under current law where it would not be subject to GILTI. Now, under the Green Belt, it's eliminated. So let's say if your foreign sub-1 has tangible assets, it generated income. 10% of that income would be exempt in the GILTI calculation. When under the proposal, if it's eliminated, that would increase your GILTI basis. So those are the two items. The third item that I would like to discuss is called FDIC, Foreign Derived Intangible Income, and that's on slide number 5. And so we call it FDIC or FDII, as you can see on the bottom. So basically, the concept is that if a U.S. corporation sells 2 products only, and both products are exactly the same, and they generate the same profit, but one product is sold to a U.S. customer, and one product is sold to a foreign customer to be used outside of the U.S., the tax rate is actually different, even though they are both reported by the U.S. corporation. So the profit that's generated from the sale to a domestic customer is subject to the 21% tax rate. The product that's sold to the foreign customer is actually subject to a lower tax rate. And you can go as low as 13.125. So this is a benefit that's offered to a lot of U.S. corporations. But under the Biden Green Belt, this FDII benefit is repealed. So this would have a big impact to U.S. corporations as well. So the next few pages, I have listed quite a bit of difference between the current law and the Green Belt, but I'm not going to go over here in the interest of time. So I would like to actually explain to you 2 examples. And in these 2 examples, as you probably can see, I'm going to show you the U.S. tax liability between current tax law and the Biden administration tax reform. And I am only going to show you the U.S. federal tax rate change from 21% to 28%, and also the GILTI tax rate change from 10.5% to 21%. And then also the 2 key components that I discussed earlier, which is a country-by-country calculation under the tax reform, the new tax reform that we are expecting, and also the elimination of the 10% of the QBI. So because of those 4 different changes, if you will see that the U.S. tax expense would actually increase by more than 50%. So in my example, and you can look at it later, I am not going to walk through step by step, but basically in this example, you have a U.S., ABC U.S. owns 100% of ABC APAC and 100% of ABC EMEA. And the facts and the assumptions are the same for both examples. And the income are also the same. The tax rates are also the same. Local tax pay are also the same because there are no changes to the local tax, right? It's 20%. So local tax is also the same. But because of the U.S. federal tax rate changes, GILTI tax rate changes, like I said, in the middle column, the last row, you can see that the U.S. tax liability actually changed. So in this current law, it's only $210,000. And this $200,000 is really the 21% times U.S. domestic income of $1 million. Now, the GILTI income, you know that we said GILTI would be taxed in the U.S., but because of the way it's working under the current tax law, the foreign tax credits, which is taxes paid in local jurisdiction, is sufficient enough to offset the U.S. residual tax on GILTI. So we did not have to pay anything extra. Now, if we go to the Biden proposal, you will see that actually the tax change from $210,000 and to the next page is actually $330,000. And this is because, one, the federal rate change. So even with $1 million U.S. domestic income at 28%, you have to pay $280,000. And in addition, because of the way how GILTI is calculated, you actually would have U.S. residual tax on GILTI. So the tax rate increased by more than, the U.S. tax liability increased by more than 50%. So that's all from my presentation. I hope you enjoyed it. If you have any questions, maybe we can talk about in the Q&A section. Back to you, Winona.
Thank you very much, Connie. It's a very comprehensive, high-level review of a couple of, international tax provisions in this short 15 minutes. Thank you, Connie. I guess in between, before inviting Wendy to her presentation, maybe I have a quick question for the audience. Do you need to deal with any of these tax provisions just discussed by Connie in your daily work life or in your personal investment? You can raise your hand, okay? You can just click raise your hand so we will have a good understanding how our audience is kind of dealing with these tax matters during their daily life. We do have a question from the audience, I guess from the registered participants. It's kind of related to the group of 7 just agreed a potential 15% minimum corporate tax from the OECD proposal. Connie, are you kind of familiar with this topic? Just a high level, maybe in between, and I can count the hands raised for you.
Yeah. So yes, I am familiar on a high level. So when G7 agree on the 15%, I guess the impact that I would see is that this would reduce the incentive for large companies to declare profits in tax havens or low tax jurisdictions. So one of the countries that I have seen a lot of large companies that are using is Ireland, right? So Ireland's tax rate is actually 12.5%. So if they agree on this 7%, I would see that the incentive for using a lower tax jurisdiction would actually be reduced, because the company that's headquartered, the country in which the company is headquartered, they will be able to top up the corporate tax payments, at least to the global minimum 15%, right? So even if you go to Ireland for 12.5, where you have your headquarters actually can make you pay top up the difference between 12.5 and 15%. Now, I also see that with this agreement, if you remember earlier, I said our GILTI rate is actually 10.5%. So I would see that it's actually going to push the Biden tax reform to raise the GILTI rate, right? Because if we only taxing 10.5%, where everywhere else is taxing at 15%, U.S. probably would want to raise that. And again, in the Biden proposal, it's actually talking about 21%. So that's way higher than the 15%. So that's another way I see with this agreement by the G7 would actually push harder on raising the GILTI rate.
Very good. Thank you very much, Connie. Okay, let's go to the next part, the second part from Wendy Lu. Wendy will talk about tax provision for inbound businesses, just as opposed to Connie's part. Wendy is a partner of Aprio, leading Chinese tax practice. She has been advising Chinese clients on cross-border transactions between China and the US for more than 15 years. Her industry expertise include manufacturing, wholesale, technology, real estate, and many others. Her clients include startups or exit stage private companies as well as public companies. Welcome, Wendy.
Thanks, Winona, and thanks Hong Kong Association in New York and Northern California for putting all this together. And I work mostly with a small to mid-sized international companies in manufacturing, wholesale, logistics, real estate, technology industry. Most of them are within a large international control group. So as Connie has covered the outbound piece, today I would like to talk about the inbound piece. So such as things to consider when structure the inbound business, and I will provide some updates on PPP and ERC credit and FFCRA credit. A few minutes to talk about the mid-year tax planning idea. So Aprio is one of the top 50 accounting firms with more than 600 team members, and 20% of the firm is actually foreign born. And we serve happy clients from more than 50 countries. So when considering what is the best type of entity for your inbound business, we usually will evaluate the tax implication from a holistic standpoint. We're not just looking at the federal tax, international tax, withholding tax, but we also look at the state income taxes and some of the non-income taxes. So also when we plan on the structure, we look at the industry and what type of industry you are in, and what activity you're going to conduct in the US, active or passive. And we look at the full cycle of the business and look at the exit strategy and repatriation of earnings. So a lot of time, the foreign owners would prefer to set up a C Corp for their US manufacturing and wholesale business for mainly the purpose of separating the legal liability. And also they don't want to deal with the permanent establishment issues if there were a US partnership was set up. However, we also have seen foreign passive investors would prefer to set up a US partnership to hold their passive investment in the US. So there's a lot of choice and a lot of consideration. And in structuring the inbound business, the withholding tax plays an important role. If a parent company comes from a non-income tax treaty countries or jurisdiction, withholding tax rate is 30%. So the cost of repatriating the money back to the parent company is pretty steep. So to mitigate these issues, we assist the client to look at their overall global structure and utilize the other existing active subsidiary in other treaty country to hold the shares of the US sub, such as using the UK sub to hold the US sub share. As the Green Book, the Biden proposal, tax proposal was just announced last month, I think now might be a good time to reconsider your choice of entities. Because the Green Books propose various rate increases, including a corporate tax rate, individual tax rate, long-term capital gain rate, qualified dividend rate, and also, like Connie just mentioned, they doubled the duty effective rate. However, there's some good news though. The Green Book keeps the few favorable deductions, such as the 1998 deductions, to make the flow-through entity might be more attractive now. However, on the Green Book, they also propose one provision, and probably a lot of the people might overlook. The proposal says they will put more flow-through income to subject to the net investment income tax and self-employment taxes. And also the Green Book proposed a limitation on foreign tax credit for sales of hybrid entities. That would actually affect a lot of inbound business with a foreign operations. So those potential tax implications of all this needs to be carefully evaluated before you actually structure the business. And we have seen that some multinational companies set up their US operation by product or service line. So each US entity is like a brother sister of another, and they don't file consolidated return because they don't have a US common ownership. So this type of brother sister control group oftentimes face unfavorable tax consequences because the tax attributes of the US component entity will be trapped within the group, and they share the same tax limitation as a group. And while the income of one component entity cannot net with the other entity's loss. So consider to aggregate the brother sister company into one US common ownership, because that usually the straightforward parent sub structure would generally bring in more tax advantage. There are more to cover. So be aware of the adverse tax situation when you sell a partnership that owns a CFC with the undistributed earnings and profit. I mean, I run into this situation a lot of time, and the CFC would be considered indirectly sold, and all those undistributed earnings and profit in the CFC will be treated as an ordinary income. And the ultimate US individual partners of the partnership will be taxed at the ordinary tax rate, and no foreign tax credits would be allowed. Well, there will be some solution to mitigate this situation. So just keep that in mind. So it becomes more and more common that the inbound business have foreign operation or set up a CFC, the control foreign corp, as the economy is more globalized. Just like my client, they're a foreign-owned US company, but have operation in Northern America and Latin America. So just be mindful when structure those business, or when you try to reclassify the foreign entity for US tax purposes. I'm not trying to go through a list of the things to consider when structure the business. Is very complicated. There are numerous factors to consider when structure the business. So I'll just jump into the ERC very quick. So I presume the audience are familiar with the ERC. So I want to touch base on a few things. First of all is the affiliation rule. The ERC affiliation rule is different from the affiliation rule applied to PPP. In a parent sub situation, if the ownership is more than 50%, the parent sub will be considered one employer in ERC qualification test and the calculation. And if an individual or trust ownership structure, then 5 or fewer individuals and trusts own more than 80%, then the affiliation group will be considered as one employer. And we receive a lot of questions from the client regarding whether to include a foreign parent company when we qualify the ERC and doing the calculation of the credit. So foreign parent company will be excluded for ERC purposes because non-US employee will be eligible for ERC, and the foreign gross receipts will be excluded and the gross receipt test calculation. So therefore, we take a position that the foreign companies will be excluded. Since there's no double dipping on the benefits, so same wages cannot be used in 2 places. So practically, we will apply the qualified wages to PPP forgiveness and the FFCRA credit first, because those are dollar to dollar. But beware of the interaction of the R&D tax credit and the WOTC credit. Tax treatment, the credit will be claimed retroactively as a refund on the amended payroll tax return, but prospectively, the credit can offset the Form 941 liability on the current quarter payroll tax return. And any excess will be refunded. The IRS is very slow on processing the ERC refund claim. So therefore, the current ERC claim, the Q2 ERC will try to claim the Q2 on the current Q2 941. So the taxpayer would get the instant benefit. Keep that in mind, the wages deduction will be reduced by the credit amount. So in other words, the credit is taxable. IRS has not issued a clear guidance on the timing when the credit becomes taxable. And also the states are still going through the legislative process to either depart from the federal tax treatment or conform with the federal tax treatment. I'm gonna skip the FSCRA credit. Anyway, it's got extended to September 30, 2021. As the pandemic still ongoing, I think more and more taxpayer becomes eligible for the FSCRA credit and benefit from the credit. So let's jump to the mid-year tax planning very quick. So the COVID and the new administration brought a lot of challenges in tax planning and the compliances, but I believe at the same time, it brought in some opportunities. So make sure you maximize all the benefits that provided by the 3 tax bills passed during the COVID. So maximize the PPP loan forgiveness and the credits. And if someone in the audience working in the hospitality industry, and make sure you apply for the restaurant revitalization fund grant and maximize the NOL carryback opportunity provided by the CARES Act. There's some strategy that we can apply, like changing some accounting methods and change the transfer pricing policy to maximize the NOL carryback. And profit sharing, I think a lot of people overlook this beneficial provision. So if you have not filed the 2020 tax return, consider establish a profit sharing plan for 2020 and make contribution to the plan. And take a deduction and save income tax. And then the next couple slides, there are some small tips on saving the taxes. And I'm not gonna go over it, but keep in mind, small things does add up. So don't overlook some looks like a small items, but at the end of the day, it might bring you some good surprise. So there are 2 TCJA provisions will go effective on 1/1/2022, and one is the R&D expenses. Starting 1/1/2022, R&D expenses are required to be capitalized and amortized over 5 years. If R&D expenses incur outside of the U.S., we're required to capitalize and amortize those foreign R&D expenses over 15 years. So this requirement might turn the loss situation to a profit situation for lots of technology company. And also if the CFC is responsible for R&D development, and we'll recommend you to review the intercompany payments related to the foreign R&D activities and evaluate the impacts of the capitalization and also the impact on the PT tax calculation. There's another provision actually go effective starting 1/1/2022, which is the interest expense deduction limitation is calculating based on 30% of EBIT. Means the depreciation and amortization will not be added back on the base. And that means less interest expense would be allowed to be deducted. Let's see. And in lieu of the Green Book, the Green Book proposed more limitation on the interest deductions on multinational group, such as the member's interest deduction is limited to the sum of its interest income and 10% of its 163J, which is the interest expense limitation, the adjusted taxable income, the EBIC. There's sunset rules in TCJA, and most of them are individual tax provisions. So if you have a pass-through entity and you try to project the company's cash flow and the individual owner's tax liability for the next few years, and make sure you consider the 2025 sunset provision and also the potential tax law changes. There's one thing that on the bonus depreciation, starting 2023, bonus depreciation percentage will be reduced by 20% annually until it turns to zero rate in 2027. So keep that in mind when you try to project your company's budget. You either accelerate the deduction or making an election for the bonus depreciation or opt out. So transfer pricing, the 2020 and 2021 COVID years actually make the profit different from the other years. So we recommend you to review your transfer pricing policy. So companies using profit-based transfer pricing methods need to re-examine how they're applying their methodology immediately, especially those are experience a change in profit due to pandemic. So if you have excess foreign tax credit, you might want to review how your income is currently sourced and make appropriate adjustment and classification and boost the foreign source income. And multinational companies are encouraged to examine their current structure and determine if there's a more advantageous structure that can be used. And it's very complicated tax code and regulation that we are dealing with. So a lot of the multinational company may not prefer aggressive changes on the structure. In this case, I will recommend them to proactively manage the global effective rate and monitor closely on the activities and run the planning models and make flexible modifications. So I particularly put flexible means there's a lot of uncertainties on the new tax law changes, and also the political factors also, it's really bringing a lot of uncertainty. So I'm not trying to run an exhausting tax planning list today, but hopefully my presentation provides you some valuable insights. Thank you so much. Back to you, Winona.
Thank you, Wendy. That's really a long list. Thank you for reminding us, thinking back and thinking forward in terms of all these, sunset provisions or the future provisions. I guess the next part would be the Q&A. I haven't seen any questions from our audience yet. Maybe I will just chime in and ask my question to Wendy first. So Wendy, I know you've you've advised many companies from China or from Asia Pac. What do you see they are trying to be more adaptable into the U.S. tax law changes, or their kind of supply chain changes in terms of this dynamics, pandemic, as well as the policy changes? Any thoughts, observations?
Yeah, I just share some of my observation. It has been very interesting in the past 15 months, and to see how these Chinese-owned or Chinese multinational company, how they do. A lot of my clients actually they actually turn to profit in the COVID years, because the custom duty issues, the pandemic actually did not slow down their business, but rather like boost their business. So a lot of them turn into profit, and especially those that actually doing the PPE products. So what they now is more proactively looking for tax saving. So in the past, pre-COVID, a lot of the company incur losses, and they're not very proactively looking for any tax saving or any tax planning. And now, because the business turned to profit, so they ask for advice on tax saving. And I have seen a lot of a Chinese company when they set up a US sub, and after a few years, and they actually going to Canada and Mexico, Argentina, Brazil to set up a CFC. So it's very interesting. And then they learn, they learn the tax code and regulation slowly, but they're learning. Yeah.
Okay, one good thing to hear, they are turning from losses to profits, even during pandemic years. Yes, I have some clients. They are doing the same thing. It's amazing, which means they've seen or they've planned well ahead of maybe other people. That's why, or other companies. That's why they can really get some profits. Connie, I don't know if you heard my question to Wendy. Do you have any observations from your clients, from the companies you work with, any changes for either outbound businesses or inbound business from Asia Pac's perspective? Because I see in our audience are mostly from Asia Pac.
Well, so when you say changes, are you talking about in anticipating the Biden administration tax form, what we are doing right now, or?
Yeah, maybe you missed my question.
Okay.
Adapting themselves to this environment in terms of tax or other, changes. Mm-hmm. For example, supply chain, right? That's part of the hot discussions.
Mm-hmm. So right now, what we are helping most of my clients are actually thinking about how to accelerate income or defer tax deductions, right? Because the tax rate is actually going up 7%. So just looking at that, you would have to pay 7% more taxes. But, by doing some planning, doing some tax method changes, or doing some elections, you might be able to actually achieve tax savings by not making a lot of operational changes, right?
Okay, great. I think maybe like for 1 or 2 minutes recap for our discussions today, I would like to point it out some of the real important provisions that will go away or which are new because of the CARES Act. For example, both Connie and Wendy mentioned NOL carryback. You know, NOL carryback is a significant tax saving change because of the CARES Act. Most of people already know that under 2017 tax reform, NOL carryback has been repealed. Basically, you cannot carry back anymore. You can only carry forward indefinitely. However, because of the pandemic, CARES Act enact NOL can be carried back for 5 years, but only for 3 years of NOL, 2018, 19, and 20. Okay, so you basically can use your 21% NOL to offset your 35% taxable income in the prior years. That's a huge saving for you. So this provision, please keep in mind. And the other one is the R&D, as Wendy already explained. And 163J, that's another big item you need to consider, because these days almost every company will have different levels of interest expenses, right? So if you want to take something away, I hope you keep this thing in mind. And if you need help, you can find Connie, Wendy, and myself, or your own, tax advisors for to continue the discussion. Really appreciate Hong Kong Association in New York, as well as in North California, to organize such a great event. Let's stay connected. And we hope to see you in the next couple of events. We have the session on July 13 for individuals. The speakers will also provide a lot of insights of the Biden tax planning or the changes for the future, especially for individual tax. Okay. I guess this is all for today. Thank you everyone for joining us. And